Imagine that right now you open your wallet, pull out a crisp €500 bill, hold a lighter to it, and calmly watch as it turns to ashes. Madness? Absurd? No sane person would do that. But the paradox is that this is exactly what you're doing right now if that €500 is just sitting on your bank card, or, even worse, in cash in your nightstand. Right at this very moment, as you watch this video, the invisible and most ruthless tax in the world is chipping away at your money bit by bit. Its name is inflation. Most people think, I have €500, that's a small amount. I'll save up a couple thousand and then I'll start thinking about investing. That's the main trap. While you wait for that mythical moment when you'll become rich, your money is melting away. In recent years, the purchasing power of the euro has fallen so much that with the same €500 today, you can buy a quarter fewer things than you could a few years ago. Money that just sits there is money that dies. Today, we're going to fix that mistake. We won't be talking about guaranteed success, secret crypto signals, or get-rich-quick schemes that promise to make you a millionaire by next Tuesday. The internet is already full of that nonsense. We're going to talk about a sensible, legal, and mathematically sound way to protect your €500. Watch this video to the end, and you'll have a ready-made, no-nonsense, and completely transparent plan. Exactly where to put those €500 right now to at least protect them from inflation. You'll realize that investing isn't just for the wealthy. It's basic financial hygiene for the modern person.
Don't forget to drop a like and hit that subscribe button.
A person decides, that's it, I want to save my €500. What do they do? The first thought is to put it in a standard savings account at a European bank. You open the app for your hypothetical Sparkasse, Revolut, or ING. And what do you see there? At best, you'll be offered 1.5 to 2% per year. At worst, 0.1%. Now let's look at real inflation in the Eurozone, which has fluctuated between 3% and 8% at various times in recent years. Let's do some basic elementary school math. If inflation is 4% and the bank gives you 2%, then every year you are guaranteed to lose 2% of your money. A bank deposit today is not a way to make money. It's a way to lose money just a little slower than usual. The bank makes money off your money by lending it out at a much higher interest rate while leaving you with crumbs. The second popular myth is spend all €500 on some trendy cryptocurrency or shares of a well-known tech company. This is a classic survivor bias. We hear stories about people who bought Tesla stock at rock-bottom prices and saw their wealth skyrocket, but we never hear the stories of the millions of people who invested their last savings in a hyped altcoin and woke up the next morning with zero in their accounts. For a sum of €500, aggressive risk-taking is foolish. If you have $1 million, you can risk 500. But if €500 is your starting capital, then losing it because some Elon Musk made an ill-advised joke on social media is financial suicide. Why are we constantly drawn to such foolishness? Our brain is evolutionarily very cunning. It doesn't understand the concept of long-term planning 10 to 20 years ahead. For our primitive brain, short-term gain here and now is what matters. Catch a mammoth today, eat it today. This is exactly what the creators of get-rich-quick courses take advantage of. They sell you the thrill of getting rich fast. But real, honest finance is, oddly enough, a rather boring process. It's not a casino. It involves regular, systematic actions. Imagine a dam.
If you try to pour a bucket of water onto a dry field, it will simply evaporate within half an hour. That's what your one-off attempts to make a quick buck are like. But if you create a system of channels where even a small stream flows constantly, in a few years, a blooming garden will grow in that spot. €500 is that very first stream, and our task is to channel it in the right direction, not let it evaporate. So let's move on to concrete, solid tools. We have €500. How should we allocate them right now from a common sense perspective? We'll break this process down into clear steps and specific options. Step 1. Assessing the foundation. Before investing even a single cent, ask yourself a tough question. Do you have a safety net? If this €500 is literally the last money you have in your life, stop. No investments. Put it in the most accessible savings account where you can withdraw it in 5 minutes if your car breaks down or you get a toothache. You should only invest money that you can afford to be without for the next 3 to 5 years without it ruining your life. If you have a safety net, let's move on. Step 2. Choosing an investment vehicle. For an amount of 500 euros, we have 3 sound and viable options within the European context. Option A. Bonds and money market funds, money market ETFs. If your top priority is maximum safety, your best choice is ETFs linked to central banks' short-term interest rates, for example, the Euro STR rate in the Eurozone. Currently, such funds offer returns of around 3 to 3.5% per year. How it works: you sign up with a major European broker, Trade Republic, Scalable Capital, Interactive Brokers, and buy a share in such a fund. Pros: the risk is practically zero, the yield is higher than on standard deposits at most banks, and you can withdraw your money on any trading day without losing the accrued interest. This is the ideal place to park your money so that inflation doesn't just eat it away. Option B. Broad Market Index ETFs, Global Economy. If you're ready to invest for a period of 3 to 5 years and understand that the market can fluctuate, then the best choice in financial history is funds tracking the MSCI World or S&P 500 indices. For example, a fund that invests in the 1,500 largest companies in the world from developed countries. Real-life example: by buying a single share of such an ETF, for example from iShares or Vanguard, with your 500 euros, you instantly become a tiny co-owner of Apple, Microsoft, Nestle, ASML, and hundreds of other giants. Plus, the historical long-term returns of such funds are around 7 to 8% per year in local currency. This fully offsets inflation and generates real capital growth. If a single company goes bankrupt, you won't even notice. That's what diversification is all about.
Option B. Investing in your own productivity. This point is often underestimated, but at a stage when you have only 500 euros, it could be the most profitable investment of your life. If you spend those 500 euros on quality training, professional software, or a skills-building course that allows you to earn at least 100 euros more per month from your job or freelance work, what will the return be? Let's do the math. 100 euros a month is 1,200 euros a year. You invested 500 euros and earned 1,200 euros over the year. That's a 240% annual return. No stock market in the world will give you the kind of return your own brain can deliver if you invest in it wisely. Step 3. Automating the process. Once you've made your choice, the key is to set up what's known as a savings plan or Sparplan as it's called in Europe.
Most European brokers allow you to do this completely free of charge with no purchase fees. You can set it up so that your 500 euros isn't invested all at once, but rather, for example, 50 euros each month for 10 months. This will completely relieve you of psychological stress. You won't care whether the market is rising or falling right now. You'll be buying assets at the average, most favorable price. Now, let's rise a little above the dry numbers and charts. Think about it. Why does the topic of investing evoke either panic or boredom in most people? For centuries, we've been taught the paradigm that money is the result of hard, exhausting physical or mental labor. We were taught to trade our time for euros. And when we're told that money can work on its own, a deep-seated cultural resistance kicks in. This is a scam. It's too easy. There's a catch. But the key insight is that the 500 euros you invest today isn't just a way to buy a little more groceries in 5 years. It's an investment in your future freedom. Every euro invested in tangible assets is like a tiny worker who starts working for you 24 hours a day without days off, sick leave, or vacations. When you sleep, it works. When you rest, it works. The difference between a financially dependent person and a free person isn't the size of their car or apartment. It's about who controls their time. Starting small, even with just 500 euros, you change the very structure of your thinking. You stop being just a consumer with money burning a hole in your pocket. You become an investor. That is, a person who looks to the future from a position of strength and control, rather than from a position of fear of the next economic crisis. Remember, there is no perfect moment to start. Markets will never be completely calm, and politicians will never stop printing money, driving up inflation. But your 500 euros is a very real force right now if you take it out from under your pillow and put it to work according to the rules we discussed today. I believe that you have the composure and discipline to take that first step. Now I have a question for you. Let's have an honest conversation in the comments. Share your experience. Which of the strategies we've discussed resonates most with you? Write your thoughts below. I'll definitely read them and respond to the most interesting comments. See you in the next video, and may your money work for you, not against you.